Good morning. Today we are learning about dividends, how and why companies pay them, and how they can benefit us as investors. When a company earns a profit, it has a decision to make between reinvesting those profits in the company so that it grows and increases future profits, or returning that money to shareholders. They can return money to shareholders through share buybacks or through dividends. So let's look at how some companies handle this decision about how they reinvest profits or return profits to investors. We'll start with Amazon. If we go to Amazon's dividend information, it says here Amazon does not currently pay a dividend. Amazon reinvests all of its profits in the company. So if you own Amazon stock, you're counting on making money on capital gains on this stock price right here increasing in the future. Let's look at an older company that's been around longer than Amazon. Kroger's been around for about 70 or 80 years and is a little bit less growth focused. It's more about just maintaining the current earnings it's getting from groceries, for grocery sales and similar parts of the business like that. So Kroger does pay a dividend. It pays 72 cents per year. That's about 2% of its current stock price. So if you bought it, you'd be getting a return of about 2% per year in dividends on what you're paying for the stock today. This represents about 22% of the company's profits. So 22% of the profits go to shareholders through dividends. The other 78% is either reinvested in the company or used for share buybacks. Probably most of that remaining 78% is being reinvested in the company. Over the last 5 years, the dividend has been growing by about 11%, and the company has maintained dividend growth for the last 14 years. So this is a very reliable dividend. Let's look at one more example of a dividend-paying company. This is a real estate investment trust. And with real estate investment trusts, they're actually required to return 90% or more of their profits to shareholders through dividends. They pay out $1.40 per year in dividends, and that actually represents almost 11% of the current share price. Their payout ratio is currently a little more than 100%, which means they actually have paid out in the last year more dividends than they earned in profit. Now let's talk about what you need to know about dividends. These are the definitions of what we just looked at with those couple companies. The dividend rate is how much a company pays out in dividends. This is a cash amount. It's usually by the year, but you'll need to pay attention if you're looking at different websites to if they're talking about the annual dividend rate or the dividend rate each quarter or however often the company pays the dividends. There are a few companies that pay a dividend every month. Some companies it's once a year, twice a year, 4 times a year. The dividend yield is how much a company pays out each year relative to its share price. So that's a percentage. So if you bought shares for $10 and the dividend each year is $1, that would be a 10% dividend yield, which would be a high yield. Most companies have lower yields that are around maybe 1 to 2%. The dividend payout ratio we already talked about a little bit with each of those companies. It's the percentage of earnings or the percentage of profits that is paid to shareholders in dividends. We'll talk a little bit more about that in a second. And then the other one we just talked about was the dividend growth rate, which is just how much the dividend grows each year. A dividend payout ratio is a really important number because it tells us a lot about the company, if it's focused on growth or if it's focused on return to shareholders, and also if its dividend is sustainable. A low ratio or no dividend is usually a new or growing company, a company that is focused on growth. And if the shareholders want to collect some cash out of their investment in the company, they would need to sell shares. A higher dividend payout ratio is probably an older, more established company, or it might be a real estate investment trust or some kind of limited partnership that has a unique tax structure. These are companies that are giving most or maybe all of their profits back to shareholders so that the shareholders are collecting regular income from the company. That means the focus is not as much on growth through reinvesting profits. If the dividend payout ratio is higher than 100%, then the company is actually paying out more in dividends than it is earning. That is not a sustainable situation. This does happen sometimes, and it doesn't have to be a big deal if it happens one time for a year or two, especially if there's a special situation that's affecting earnings. But over the long term, if a company is consistently paying out more than 100% of its profits, that cannot continue forever. It will run out of money. So it will have to reduce the dividend. It is not good when a company reduces the dividend it's paying. It hurts the shareholders in terms of income, but it also tends to hurt the stock price because some shareholders who are relying on that income will sell the stock. So that's a little bit about dividend investing. Check Google Classroom for your assignment for today and email me if you have any questions. Have a great day.